What is going on, everybody? Welcome to the Wealth Workshop podcast. This is the show where you learn all things how to do wealth better. With me is Jacob. Jacob, how's it going today?
It's pretty good. I've got this little like nasal thing in the back of my throat, but other than that, I've been good.
So, are you apologizing in advance for your voice? You sound
I
normal.
I don't think it's going to be too bad. It's more so of annoyance for me, I think, that it will be for anybody listening.
Got it. Well, we've got a good show. We're going to be talking about private equity, and they're coming for everyone's 401ks. I'm excited about that. But before we get into that, I want to ask your honest opinions on OpenAI's new model, ChatGPT 5.
You
Because
want
I
to know
think a
what I
lot of
don't like
our
about it?
okay,
I don't like that it has like the auto feature. Like I'll put a question in there and it'll think for way too long. Like I don't want you to think. And I know like you can click like get fast answer, but like sometimes I'm like, well, is it actually going to be better if it thinks for me or is it not? And I think it just gets way out of control if it starts thinking too much.
yeah,
I liked being able to switch between like 4.0 and like O3 mini for like different tasks if I wanted more reasoning. I've been using Perplexity a lot.
yeah, yeah. We both have been using the Comet browser, and that's been really cool. Like, there's
Yeah.
things that I don't love about it, but I was using ChatGPT's. Well, actually, you don't even have a choice really anymore because we don't do the coding stuff. Well, you do some of it, but yeah, I think my I've had like two aha moments with these models, ChatGPT in particular. The first time I used it, I was like, "Oh my gosh, this is crazy." Uh, yeah, I had it write a blog about like making a cocktail, which is crazy because we don't like my wife and I we don't really like drink cocktails. But I remember in our kitchen, this would have been a couple years ago, just writing a blog about. I think I was showing my mom or Camila something like that. That was the aha moment number one. And then the last aha moment I think I had was when like it was either 3.5 or 4 and where I just noticed that its ability to edit the newsletter that I write where it was just so much better. And then like I had extremely high hopes for 5 and I don't know. I definitely have been I think felt like how a lot of other people feel. It's like, whatever.
I remember a couple of years ago when ChatGPT first came out, and the joke around the office was like nobody could pronounce it right. We were always saying like ChatGPT
Oh
or
yeah, dude,
you
I
know.
was number one perpetrator there. I got
That
it
was
now.
great, but yeah, I mean it's way better now. I mean I don't even know if I could live without it anymore, and I never thought that I'd be paying for multiple different AI
I know,
chatbot
right?
subscriptions. Never could have forecasted that a couple of years ago.
So this has caused obviously, oh gosh, like in the investing landscape, just things are changing fast. So I wrote in this week's newsletter. I think I quoted Sam Altman on. He was on the Squawk Box. This was a couple weeks ago. He just did like the big PR push on, hyping everyone up on ChatGPT 5. And he was talking about like the adoption rate was so high. It's obviously right because they had
Forced you
we
to
all had
use
these,
it.
yeah, we had these huge expectations. And then it's like you did not have a choice. Like you had to. So a little bit of a weird business move. Obviously, it didn't go very well with them. But he was on Squawk Box and Andrew asked him, like, what do you feel about being private? Because Andrew was talking about how some shares of OpenAI in the secondary market have traded out of $500 billion valuation, and he, I think like OpenAI knows it's going to be probably like a multi-trillion-dollar company valuation. Like that's probably where they're going. Sam was like, I'm going to be like, this is going to be a publicly traded company, but at this moment in time, with how volatile it is, like, it makes sense for us to be private. I was like, okay, whatever. Like that's his opinion, but it's pretty crazy to think about how there's been $500 billion of value creation in such a short amount of time while the company is still private.
And it's not the only one. Like there's Stripe and SpaceX.
Hmm.
I mean, those are just a couple more. I'm sure there's plenty of them that are like $100 billion companies that are just private.
Yeah, there's a lot of them, and, obviously, this is again, this is what I wrote about in the newsletter, but this has just changed, changed the investing landscape, when when just, like, normal people just don't have access to these companies, and they miss out on, like, an enormous amount of growth, and just for context too, so I looked up the market cap for Amazon 10 years ago, and it was I think it was like a $320 billion company 10 years ago.
So OpenAI is bigger than Amazon was 3 years or 10 years ago.
Yeah. I mean,
It's
it's
probably
just
and bigger than Google too, right? Like Google was probably about the same valuation 10 years ago.
maybe. So the amount of value creation that's happening before just like regular investors, even like high net worth investors, you don't even have a shot necessarily. And so on August 7th of this year, President Trump signed into law the executive order, excuse me, an executive order stating that 401k plans can have alternative assets in them. What
Yeah,
was your
but
take on that?
I think the Department of Labor, I think they have like 180 days to issue very specific guidance.
Hmm.
I think like he basically opened the door to it. I don't necessarily think like he gave the stamp of approval. He basically like removed the barrier for the Department of Labor and like ERISA and like all like the folks that actually like regulate that space
Hmm.
to bring private investments into it. Now, there's plenty of lobbyists, obviously, like Blackstone and whoever else, like want to get access to the $12 trillion 401k market, where liquidity is already like not really available because you have to wait until 65 before you're like penalty free withdrawals. So I think it's a good step of just like opening up the door for investors to have a greater access to these types of companies that are private still,
Yeah,
making a lot of value.
this is like Trump, love the guy or hate him. He's a business guy, so he's been raising money. He's been dealing with banks. He's been buying and selling real estate, licensing his name, image, and likeness for his entire career, right? And then he made the switch into politics 10 years ago. So he like definitely understands this, that what's happening in the marketplace. And I was reading over the weekend about the London Stock Exchange and just the companies that are like, this would have been, gosh, I don't even know, probably how many years ago was this? Well, we had like Medtronic's an international company now, so we had U.S. companies going overseas, where now the U.K. is like, oh my gosh, we're losing some of our best companies. The amount of like publicly traded companies is just shrinking, and what
Hmm.
that means for normal investors is, and normal, I guess what I mean by that is like under 10 million in assets. So this covers like a huge swath of the country. Um,
Yeah.
they don't even like have access to these companies because the amount of companies that we can invest in are just shrinking rapidly.
Well, and I'd even make the argument that like even people with more than $10 million don't generally have access to these types of opportunities because when you think about it, like who has the ability to give OpenAI money anymore? It's like the biggest venture capital funds or private equity funds that exist, and they're probably set up to be like, yeah, we're taking like $100 million checks from pension funds versus like
Yeah, you can't even get
small
it.
checks, right? From like $1 million check from a person that has $15 million, like they're probably not going to take that check.
Yeah, yeah. Well, they're
So
not
this
going
is
to
a
take
step.
it. So
Yeah,
then you have to get it. Then you have to get it through a fund. So what I was writing about in the newsletter is like investing just got a lot harder
yeah. I mean,
because
yeah,
now like
it
people are
definitely
going to
did.
open their 401ks. They've got like they've got the target date fund, which most people choose. I guess not most, I shouldn't say that, like many people just dump it in to the target date fund. Got some index funds, some active managed funds, but I think what's going to happen is people no matter how this plays out, they're going to be investing in things that they don't understand. And even for us as professionals, like we're on the the wealth management side. So some of these funds are just really complicated.
Yeah, and very expensive, and sometimes they're not super transparent about like what it is they're actually doing. Or at least like it's really hard to understand what they're actually doing. How do they actually figure out how to invest in a private company? Like what's the structure of the terms? They're just not things that ordinary investors know how to do or know how to like decipher. My fear, of course, is like, what does it look like in the 401k when like they have options to these things? Like this might be 3 years from now. This probably isn't like a 20. This certainly isn't 2025 thing. It's probably not a 2026 thing. But like when it actually shows up in the menu of options for an individual investor, like do they just check the box? And like what disclosures is it going to show them? Because you wouldn't want to just be like, here's the performance of X private equity fund and click the box without even realizing that like you might be signing yourself up for more than you realize.
Hmm.
High fees,
Totally.
lack of transparency of like what you actually own, um,
Yep.
just because the 10-year performance numbers nice
Yeah, like people are gonna
or
they're
could
gonna
be
see
nice.
they're gonna yeah they're gonna see they're gonna log into their portal. They're gonna see the options. They're gonna look at the returns, and then they're gonna pick those returns, or they're gonna pick the fund based on the returns. Like that's just unfortunately how most people invest. This is like you know, indexing, just dropping money into the S&P 500 or just large cap stocks in general has been such a good strategy. There's an article written yesterday, like the entire market is being drug along by like four companies, right? And there's so much value in indexing. And people have just been like, the S&P 500 has worked, so therefore I'm going to invest. And I think like people are just going to see these private equity funds, and like they're not bad. Like I don't want to say that these funds are bad, because that's not true. they're going to see they're going to see the returns, and they're going to be similar to the S&P 500, but they're going to see a higher dividend yield, and they're just going to invest based off of that, thinking that the structure is similar to the S&P 500 index fund. I think these private equity backers, they're going to have to figure out the liquidity piece for investors to get their money out. But the structure, I have to think, is going to be just different than an S&P 500 index fund that Vanguard puts into all of his plans.
Well,
You think I'm right on
one
that?
other thing is like, yeah, I think so. The thing is like with large, let's just say large cap strategies, whether it's growth, value, blend, whatever it is, like they all tend to do they have like similar volatility profiles, similar return profiles. Like, of course, like growth has vastly outperformed value, but like there's been times where value has outperformed growth as well. Um, with private investments, like who you choose to manage your money matters so much more, because it's not just a ticker on a stock exchange where you can just say, I want 8% or I want 5% the next day. Like that's not how these things work. So how like these managers even select the assets that they're owning inside of these funds vastly changes the return and risk of each one of the different funds. So like choosing between a menu of 7 large cap funds is entirely different than choosing between 7 different private equity funds all investing in, let's just say, primary or co-investments. Completely different process to actually pick those.
Yeah, and that's where I think people are going to get screwed over. Is
Totally.
like they think, yeah, they think that because it's the fund is like next to the fixed income allocation, however somebody goes in and chooses their 401k option, it's going to be like the asset classes are just so different. And that's the reason why this, I think people are um like, why President Trump made this executive order, to give it to the DOL. And my guess is the DOL is just going to go through with it, right? Like
Well,
when
yeah.
you have
Yeah.
Vanguard looking at giving investors the option to put these into plans, like if Vanguard's doing it, the US government is absolutely going to listen. And same with BlackRock, right? Like when they bought HPS, I think that was earlier this year. And I think what I love about this and where I think this makes so much sense is, and again, this is what I wrote about in the article this week, was it just gives people freedom. Like when investors have more choice, like that is undoubtedly a good thing. Of course, when people have more choice, of course there's more ways to go right and there's more ways to go wrong, and that obviously, like the choice is going to be tricky, and I know people are just going to honestly, like this is just what's going to happen, they're just going to guess wrong, when they
Totally.
look at their but it wouldn't surprise me if there's like guardrails or something where it's like you can put up to 25% of your money in one fund, or in the
Mhm.
alternatives bucket in your 401k. Like I would imagine that's how they're going to get around the concentration risk.
Yeah, I also think, what might end up happening is like the Department of Labor or ERISA, they'll have some more specific guidelines on like the types of funds that can be available into 401k plans. Like funds have to
Yeah.
meet a certain asset minimum, so you're not like dealing with random tiny, hugely speculative like private credit funds, and you're dealing with maybe more of like the big institutions that are just watched more closely by
Hmm.
the SEC or by whoever else. Um, that I think like that will generally be the direction that the DOL will go, because ordinary investors are not going to be they're not necessarily going to know the difference in all cases. Like they're going to look generally the same.
So if you had, $2 million in your 401k, you're 55, you've done really well, been at the same company for 25 years, and you opened up your plan and you had options to invest in crypto, real estate, private equity, because I'm guessing people are going to have like 3 to 5 options. I would think that's what they would do. How would you go about allocating?
You know, so I certainly would. I think I would like personally. I would build allocations to these things. Like I've got a long time horizon. Like I don't have any need to like.
You're a 55-year-old.
Sorry. Well, even at 55, like you got a pretty long time horizon of 10 years before you're really like gonna even think about drawing money from this. And hopefully, if you've got a big 401k plan, you also have like brokerage assets outside of it where you might not need to touch your 401k until you're 70 or 73,
Hmm.
when you're 75, when you're starting RMDs. Anyway, but like it would certainly start small. I wouldn't like be like, okay, $2 million. All of a sudden, there's $200,000 directly into private investments, or 300,000, 100,000 into a private equity, private credit, private real estate fund. This would be like, okay, maybe I'll start new contributions. Like I'm going to allocate 10% of my new contributions toward these types of strategies, and just assess how it's actually working, and if it actually feels good. Because I
Hmm.
wouldn't want to just like throw a bunch of money in there and then regret it. This is a story of like 401k plans are built to like build assets slowly over time. And because contributions are made every 2 weeks, like it's a pretty easy way just to like slowly build a position there. How would you do it?
Here's exactly how I do it. So my first call would be to my advisor. So this is the case where, working with somebody uh, who just oversees more than just 401k. So I'd call my advisor, and if you didn't have an advisor, I would go to the plan sponsor, and I would just I would have a conversation with somebody. Like in this case, I would have an advisor. Be like, what is this thing in plain English? What is this? The second question I would ask is, um, where would I get screwed over?
Yeah.
um,
Yeah.
like what could happen where this would go wrong, right? um, and then because the answer is going to be way different than an index fund, like the answer is going to be different, and I think understanding, that's what I would want to understand is, first, what is this thing? Second, where would I get screwed over? And thirdly, it would be, okay, well, what's the plan to buy in? So I think what I would do is I would probably carve off, I don't know, maybe like a 5 or 10% just chunk immediately. And then what I would do is just like you said, is to uh, re just redo the contribution strategies of where the contributions are going and building that position over time. I think where I have seen investments go right and wrong is when just investors make a too big of a jump into one or two alternative investments. And there was an article yesterday in CNBC. It was about, I think it was like a mid career Wall Street guy. He put, I think it was $400,000 into a company called Yield Street, and he
Mm,
bought two funds or two investments. It was I think they were both had to deal with New York real estate. And
mm.
obviously, if you've been investing for any period of time, like people know that New York real estate is it is
Not
like,
great
well,
currently.
no, it's great. You have the money center on earth. Like there are so many people there. Like it is a great place to park money. That's why they build all those skyscrapers and people in Hong Kong, all over the world. These people, they just buy apartments and they never live in them. So it's like, like New York City real estate, like it is great. Now, I think what you were mentioning, of course, is office space, right? Where office
Yeah.
space, I think, has been in just any major metro has been rough. So this guy, like, he's on Wall Street. It's like, hey, this is a pretty sure investment, right? Like New York City, like you can't just copy and paste New York City and make it. Like no, that is like that is the money center on earth. And anyways, he ended up just getting his clock cleaned. I think he lost like one of the investments. I believe he lost like all of his money. Um, where it was some office building owned by the family office of the WeWork guy, and it was just a total loss. And the article was just pointing out that these air quotes alternative investments, they certainly aren't a sure bet. And I think just from what this article was, I think illuminating, and like why they would post this is the democratization of finance and like having these types of investments available to not just to like Wall Street, but to Main Street. It doesn't always go people's way. And I think like it's the return profiles, meaning like how much you can make and how much you can lose, are wider than just public investing.
Yeah, and there's like a couple of these, right? There's Yield Street. Like all of these things are just like they're marketed to retail, regular like investors. And they're positioned as like you can own what the 1% owns through our
Hmm.
platform. That's how it's right. So there's Yield Street, there's Masterworks, there's Fundrise, there's
Titan.
what yeah, Titan, that's what I'm thinking. Like there's all of these like democratizing hedge funds, democratizing private real estate, and like Yield Street is democratizing like the whole kind of menu of it, democratizing investing in art. But like a lot of those companies are like startup companies built to acquire those asset bases. Like just because they have the assets or have been successful in it, like doesn't mean they're successful investors. And I think like
Hmm.
I'm not saying that like every investment they ever made is bad. I don't think that's true. But like these are the things that like ordinary investors, definitely need to watch out for too, because these things are going to be more prevalent as time goes on as well.
Yeah, and I think of like position sizing. So position sizing is just like what is the investment amount divided by your net worth. And what's tricky with these like democratizing finance types of platforms is they're like invest like the 1%. It's like, well, we definitely work with people who are in that camp, and
Hmm.
um, they give people access, which is great. But what people don't necessarily understand is when you look at somebody who's got like $7 million, they're not putting like 50% of their net worth into one investment. That's like not what they're doing. So like the 1% are people who have assets. So I think it's people, it's like, oh, I have $30,000. I want to, like, I'll just put it all into this investment. Says I'm going to invest alongside this fancy investor, and I'm going to get a 20% per annum return. That's twice as much as the S&P 500, right, historically. So I think when like what's coming, of course, like that is already coming to brokerage assets, and it's coming to it's coming to, like, these types of things are coming to IRAs. and now they're coming for like the backbone of America's wealth generation machines, which is the 401k. And to me, this is just like a just got to be skeptical, because like those IRRs, internal rates of returns that they share with people. I mean, they're many cases are true. Like they've been
Well,
great, but
well,
they
in many
also can
cases,
blow
they're
up.
also a little untrue, right? Because a lot of times, like the pricing to transparency of like, well, how do they actually value the real estate that's inside of the fund? Like maybe they do an appraisal, or they do, they have their internal appraisal system, stuff like this. Blackstone got themselves in trouble, in 2022 because they didn't mark down their real estate assets.
Yeah,
And then everybody tried to sell because they were rebalancing portfolios at the end of the year, saying Blackstone's up and my stock and bond portfolio is down. I'm going to sell a little bit of Blackstone's, B REIT, and I'm going to buy some stocks and bonds at low prices. Well, they ended up, needing to gate these redemptions because, like, they didn't, they had their 5% withdrawal limit. Um, they're just like, there are definitely like problems, like functional problems that need to be addressed, like in that market specifically, especially bringing it to just like a general, more broad audience of investors who don't necessarily know all of the risks or the operations involved with investing and owning these things. I think a lot of things, and what you were saying before, can be solved and explained away by like just a good financial plan. Like if you know
totally.
what do I need to have that's just safe and stable there to provide me a retirement in 30 years? And what on the side can be like maybe a little bit of just like, hey, I can be a risk eater with this money. If I want to buy on a Robinhood account some shares of Nvidia, okay, like I know that this money over here is sufficient and capable for what I need in retirement. And this, small pot of money over here, like I can learn and I can invest and I can figure out how, you know, maybe like add different strategies. And this goes to like the position sizing, where it's like you're not throwing your whole retirement nest egg at one thing. You've just got a plan and a strategy that's just set there for you 30 years from now. Or in a 55-year-old's case, 10, 15 years from now.
I think what makes a lot of sense, for this, and I know the sponsors, like the private equity, companies, the funds that are doing private credit, buyout funds, like those are inherently long-term structures, right? So when you sign up, like when you fill out the paperwork, you're contractually agreeing to lock up your money for years, and that gives the management company or the sponsor time to invest and to turn around the company, or just time to earn coupon payments and pass those along to investors. So inherently, these are long-term vehicles. So I think in a lot of ways, it makes sense that the 401k is used. Like those are long-term vehicles, right? Like if you're
Mm-hmm.
45 and you've got $1 million, like you're not going to be using that money for probably 20 years. So they're like a great vehicle to do it. But there's also the um, like what's going to be hard is not every plan is going to get the same opportunity. So when you think about like what's great about investing in the 401k right now is you can just get, like, everyone can get the S&P 500. Like anyone can get the Russell 1000 growth. Anyone can get you know some mid cap fund, right? Like there's like it's an index. Like you can just it naturally grows, and that's the beauty of it. But like not every plan is going to get the same alternative fund. Like this is where I think crypto has a definite edge on versus like a private credit or private equity fund or like a real estate fund. Like I think there's just
Sure.
like crypto has like some advantages, like structural advantages for what the asset class is and who will be using it in 401k plans. But that is where like the what fund does your employer have is going to be interesting. And like, are Microsoft people going to have better options than Apple? Like who's going to get into our plan, right? Like, we've got like 5 people here. Like, do we even offer it? Um, that is going to be tricky.
That will be tricky. Yeah, because it certainly won't be the same. We won't have as good of options here at Fjell as Microsoft probably will.
Yeah. Well, that's interesting. So that would be a question I guess I would have too is, Um, Gosh, I wonder if employers are going to compete. And like we have access to this fund in our 401k. Interesting. I could see that happening. All right. I want to move on to Vlad Tenev. He's the co-founder. I think he's co-founder of Robinhood. So Robinhood, they um, I think I have a love hate relationship with Robinhood. There are millions of people investing in our country because of them, which is fantastic. A lot of young people. Back in the COVID era, I had conversations about options trading with people I would never, ever, ever, ever have imagined I would have. So Robinhood is doing some just awesome things, and I love what they've been doing. They obviously have, I think, ambitions of becoming, JP Morgan Chase in 50 years. I am curious to see when they rebrand, because I can't imagine they would become. It's like when you are like um, when they get to a size, they will not be Robinhood anymore because they will be there will be other companies that are going to be Robinhood against Robinhood, if you know what
Well,
I'm saying.
yeah, I mean they're counterculture, right? Like you use
Yeah,
Robinhood because you don't like regular institutions like Schwab and
yeah,
Fidelity and JP Morgan, right? But if it's so big that it is Schwab or is Fidelity, like then there will be combatants of counterculture against it itself. There was
yeah.
even it even started, a couple years ago when people were like Robinhood's too big and it's selling all of our trades to Citadel. Well, it just joined the club of Schwab and Fidelity and whoever else.
Mhm. So um so he was on the cover of Fortune this month, and the article was, it was about work from home. So I think, Fortune's audience is more like, they're not like, they're not talking about markets necessarily. So the article was on work from home and like his, pivot back to, in office for the executives. And he had a pretty strong about face on that move, whatever. But when listening to like what they want to do, it's a combination of making investing easier. It's a combination of offering more products to investors, and they also want to get in the wealth management space, which I think is interesting. But whenever I hear him talk or like about the tokenization of markets, I can't help but to think like, do we actually need this? Because like at some point, like when you can choose everything, like everything gets so watered down. And sometimes like when you have to stop, investing, like for us, like we have a stop at, like we can trade up until the end of the trading day, but usually we'll stop at uh let's call it like two
2:30.
o'clock. Yeah,
Yeah.
2:30, something like that. Like those guardrails are helpful. What's your take on that?
What tokenization of assets?
No, just like when you can do everything, do you become nothing?
I think like there's too much choice, there's too much like it's too hard to choose the right thing, right? Like if you can trade all hours a day, you maybe are trading at a time where like liquidity is not high enough and you end up shooting yourself in the foot because you don't know what type of order to put in, right? Like there's so many things where just giving people too much freedom actually hurts them more than it helps them versus like how the structure has actually been placed where it's like 8:30 the market opens, or well depending on which time zone, 8:30 for in our case to 3 o'clock. Like there's a very clear constraint of like this is when all the participants, this is when we're going to have the most liquid markets. Here are the everything listed on the New York Stock Exchange. You won't have to figure out like, am I going to buy a token of somebody's residential property in Fargo, North Dakota? Because that's like some things that people are floating by is like, are we going to tokenize real estate and you can sell one
Hmm.
tenth of your house? There are just so many things where it's like too much. It's too much like it's too many options to be good.
Yeah. I think I love the options. Like I think the amount of regulations has been dizzying, and the amount of like changes in the regulations too from our perspective, it's been hard. I'm speaking specifically in retirement planning. It's just been hard to I think it's been hard for just everyone. the regulators themselves to understand like what exactly they're shooting for here. So I love the choice. Um, but it definitely, I think what people like, this is just like this deep conviction of, well, what does that mean for me? Because like more choice is coming. Like it is like more, and that ultimately is what the innovations in AI, right? It's like you don't even need to search for anything. You just whatever you want, like whatever you want to choose to talk about, you can have, the equivalent of Albert Einstein, although I don't think ChatGPT 5 is at that level. But you just the choice, like you have so much choice. And um I think one of the paradoxes of wealth is like you become really wealthy by just making a few really really good singular bets in your life, whether that's like your career choice or unique investment opportunity. So like
Mhm.
you become wealthy by limiting yourself. But I guess the question is like, well, what limitations do you put on yourself to to grow your wealth and not work forever and be broke in retirement, right?
Yeah. I think, one of the funny things is like, well, this isn't necessarily maybe funny, but one of the things that could come of this is like there could just be a greater rift of like there's, the wealth divide could just become greater because like while greater options, people on, this side of the aisle like might just still make their one great bet in their business or in whatever they're doing, while this, the growing number of people on this side like just are just distracted by too many options. And like, so where the it's actually democratization is, the idea is to bring it all together, but in reality it's might be separating it further by just giving people too many options, but these people over here still know, you know still to your point, they know like the limited choices that they do make are the ones that create the vast amount of their wealth.
Yes. And that's where, like Robinhood, they are just highly innovative. I think they have their business is, I mean, it's legit. They've done a fantastic job. They want to get into wealth management. And I think that the reason they see this like technical innovation paired with, smart humans is is I mean, I think like that's just the reality of the job. And I think when I think of our work that we do for clients and like the future of what we're going to do, it is going to be, I think a big part of our job is going to be vetting these private assets, right? These
Mhm.
alternative assets, which they're not even going to be called alternative assets. Like they're just going to be like, if private equity's in Vanguard 401k plans, like it's not even an alternative investment. It's just like an investment, right?
It's just
And
stocks. Yeah, at a certain point it's just another category of stock.
yeah, and I think when I think about the work we did, like because we went to the same business school, like when I think about like how we were trained to manage assets, like how we were trained to think of the world, using modern portfolio theory. I think what's profoundly different is like when crypto is just it already is like crypto is already widely held. I think when those assets, they're already mainstream. I guess that's the thing I'm stumbling with is like they're not fringe, like they're mainstream. When it comes to building a portfolio and that you can rely on, that produces income, that has stability. Like if you're spending 100,000 a month, or excuse me, 100,000 a year, um, what kind of portfolio you need to build. I think that's just going to be a big part of our job is like it's not building portfolios that your parents built. I mean, these are like different beasts altogether.
Yeah. And I mean, at what point with some of these private assets does the return profile just look like public markets anyway? Because there's so much money in it that there are very robust secondary markets like the stock exchange, like the fixed income markets that like
Mhm.
at a certain point it's just liquid. There is no illiquidity anymore because there's so much money in it. And then at that point, it's like, well, now private assets are just put into an S&P 500 index fund. You don't need to have an IPO because
Gosh, is
OpenAI
that
shares
interesting?
trade on a secondary market
Yeah.
as much as Amazon did 10 years ago.
Yeah. And that's where like the tokenization where the distinction of like, do you own it or not? You know, when crypto blew up, it's like, if it's not your, what is it? Not your key, not your wallet. There's been, there's so many like cautionary tales of where this is all going about what to do and what not to do. So let's maybe wrap this up, Jay. So, it is just an objective truth that, you know, alternative, like air quotes, alternative assets, it's not, they're not even going mainstream, they are mainstream. And we certainly know it with our clients, right? Like this is just a part of our job now. And I think the, you know, when you know, millions of Americans just like wake up one day and realize that, you know, there's every participant in Walmart's 401k plan, every participant in Amazon's, every participant in Eli Lilly. Like there's so many of these huge companies that have 401k plans, you know, in the United States. When they wake up and they can see they have just options that they never had before. Honestly, the you know, people are going to go to AI, right? They're going to say like what they're going to go to ChatGPT. They're going to, you know, figure out, you know, take a screenshot and say, you know, what is this? Should I be doing this? Um, but the I think it's like, to me, it's just talking through this with somebody who just knows your life, and you know, whether that's your advisor or whether it's, you know, the advisor within the 401k plan, and just in plain English just describing what this is, and just where can somebody just get screwed over.
Yeah. I think that's a great place to wrap it.
Perfect. Well, hey, thanks everyone for tuning into this week's show. Pleasure to have you with us. If you would share this video with somebody you like, leave us a comment too. We are definitely interested in just talking about what you want. Thanks for your time and attention, Jacob. Thank you for coming on the show with me here, and we'll see everyone next week.